Hello, 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 hello. How's everybody doing? I think I'm live now. So we got our first movement on the SPY after the Fed FOMC decision. I'm told that it is 75 basis points that we've got so far. Which is pretty much in line with expectations. And for whatever reason, we're getting this massive green candle at the very start of this. However, I'm hesitant to trust the first move. We're going to go ahead and let this go ahead and print out, and we'll see where the market ends up in the next 15 minutes. There is a massive push across the entire market right now. Everything just shifted green big time. Apple, Amazon, Berkshire Hathaway, Google, Johnson & Johnson, JP Morgan. Everything is just screaming to the upside right now. This is a big hopium move right here. We're gonna get a much clearer picture of the market decision after Jay Powell comes out to speak. So be careful of this. And I'm watching things just go absolutely ballistic on the options market. The spread is widened so far on everything. Okay. So what's going on right now, Miguel, is that we got the 75 basis point decision from the Fed, which is pretty much in line with expectations. This is the only this so far is the only news that we've received. There's nothing else that's been decided, or at least nothing that's been decided that could be being made on human decisions. I'm going to see about pulling up the... sorry, my phone's going ballistic right now. I'll pull up the FOMC meeting statements. And we're going to go ahead and analyze this while we let the market make its decisions. I'm going to have the SPY over here on the side. And I will read from the Federal Reserve cheat sheet over here. So whatever their decision is, or rather what the 75 basis point decision is, isn't exactly what's important here. What is important is what the statements from the Fed are in their decisions on continued monetary policy. So let's go ahead and read through it. Okay. So recent indicators point to modest growth in spending and production. Job gains have been robust. Unemployment rate remaining low. Inflation is elevated, reflecting supply and demand imbalances related to the pandemic and higher food and energy prices and broad price pressures. Okay, the war in Ukraine is creating additional upward pressure on inflation. The committee decided to raise the target range to 3.75% to 4%. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive. So this is continued hawkish language that they are going to continue to push restrictive policy. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affect economic activity and inflation, and economic and financial developments. In addition, the committee will continue to reduce its holdings of Treasury securities and debt and agency mortgage-backed securities. So this is reaffirming their previous statements that they are going to sell assets into the market, which is, again, hawkish. So literally the opposite of what this move implies. And this is as described in the plans for reducing the size of the Federal Reserve's balance sheet issued in May. The committee is, quote, strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, blah, 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 blah. Okay. So here are the notes. They unanimously voted to raise interest rate paid on reserve balances to 3.9% effective November 3rd. So increasing policy rates further. Overnight repurchases occurring at a minimum bid of 4%. With an aggregate operation limit of $500 billion. The aggregate operation limit can be temporarily increased at the discretion of the chair. So this is in reference to reverse repurchase, which we can show on the charts. But essentially, what this means is that they are limiting operational daily repurchase agreements to $500 billion, which is they're trying to get money out of the Fed and get treasuries back so that they can be sold to at market. Their offering rate is at 3.8% with a per counterparty limit of $160 billion per day. Counterparty limit can be temporarily increased. Okay. They will be reinvesting into agency mortgage-backed securities. The amount of principal payments from the Federal Reserve's holdings of agency debt and agency MBS received in each calendar month that exceeds a cap of $35 billion per month. Okay. So they're wishy-washy right here on agency MBS mortgage-backed securities. I don't see soft language in here. I don't see any indication of pivoting. This really does kind of conflict with the move that we've seen so far. In fact, it completely conflicts with the move that we've seen so far. I'm going to bring TradingView back up here. Yeah, this one doesn't compute for me. Looking at the 5-minute chart, I see that we printed a star candle, and we're now printing another bearish candle so far. We have to see where this closes at. But I have a feeling that what this might be is just pure liquidity hunting now, trying to shake out traders. They blasted through this liquidity level. They have 2 more to go today. So we might see SPY pump to 389.50. It's possible before they send it back down. But this isn't a natural move. And the 75 basis points, while it was expected, what everybody's banking on is rumors of the Fed pivoting or getting soft. And that doesn't jive with any of the Fed's statements. I'm kind of just hanging back and waiting for these last few candles to print. What we've got so far looks like it's just a bull flag on the 3-minute chart, waiting for the market to decide on continuation. And it probably will for the time being. But the statements of the FOMC meeting confirm what I suspected, that they would keep raising interest rates. I don't think anybody was expecting a 100 basis point hike. Hey, AO. The quote stupid rise in price is, in my opinion, just institutions trying to knock out day traders and scare people away or fight other algorithms. This isn't really indicative of the market decision yet. The FOMC meeting minute notes just very plainly stated that there was going to be a 75 basis point hike and that they were going to adjust for their target rate of 3.9% for the target federal fund rate. I mean, this is just kind of what institutions do. But the opportunity here is that the market, while the market right now is behaving very irrationally, this is what institutions do in order to start getting into their positions. They force market price to adjust to where they want it, and they start working on getting their fills. And this is why I use the HTF liquidity indicator on TradingView. This indicator shows areas of previously significant price action where the price had hung around for a while, and there are likely market orders waiting to be filled here. This is where market participants, the big institutions, target for traders to get stopped out at. They hit these price levels so that they can fill those orders and they can push the market in the opposing direction. So at the moment, we're just kind of chopping around. We're way outside the price cloud on the MACD, and the RSI is so far looking like it's setting up a higher low. So there could be continuation here. We have to wait and see where this candle closes at. If we get the higher low and a bounce on the RSI, then like maybe somewhere around the 9 EMA on this 3-minute candle, this seems like significant support here. But really, like, the price is just super volatile right now. It's going to do whatever it's going to do. Taking a look at HYG, it's kind of already beginning to make a decision. I think that what's going to end up happening is this is going to come down a lot harder. So we'll keep an eye on HYG as this whole thing plays out. But I'm kind of waiting for the SPY to pump one more time. What I kind of expect is just like one more big stupid push to the upside, and then leading into Fed Powell's speech, then things are going to get really volatile all over again. But the market decision is going to lead the SPY in its continued direction for the next several weeks. So I'm very confident that the market has hit its top, because even as volatile as this is right now, even with all this volume that just pushed the market so quickly, I don't feel as though this is I don't feel as though this is breaking any previous resistances. Because no, we got stopped out where we opened the morning of November 1st. That's where this thing wicked to, and it just stopped getting up there. Now, if it can retest these levels, then I'd probably. This is why I'm looking at these levels, because you can go short here and play this ascending wedge to the downside. I've been painting, or rather, the market's been painting this ascending wedge for a while, and it's actually a part of a large bearish harmonic pattern that I've drawn out here. So you see this is what you would call a bat cipher. This is a specific type of harmonic pattern that does a high to low with a failed recapture of previous support, and then a new lower low and a lower high that falls below the original move to the downside's high. Is a little bit complicated and kind of annoying to map out. They're really difficult to spot. But point is that the whole thing is just painting a picture of bearishness. Like, all the technicals are pointing bearish. There's no conditions in the market that are bullish. So right now, we're just kind of waiting things out. Thank you, Scrap Queen, and shout out to all the mods from Hell's Trading Floor that are here helping keeping everybody keeping everybody on task with the like button and the subscribe button. Appreciate that. Why don't we go ahead and handle some other ticker requests? We'll keep the SPY in view on the watch list. I've got some price targets in mind for entering into short positions. But let's go ahead and take some requests. If anybody has anything that they'd like me to take a look at for them, we've got some time. At the moment, the market on the big cap stocks are pretty much all echoing the same moves. Everything's pushing right now, and it feels really it feels really fake. Like, nothing about this move feels very natural, and that's kind of why I'm just sitting here. I'm not like really sweating it very much. Just looking at it like, well, this kind of feels like bullshit, so. And meanwhile, I'll enjoy a sip of my Bones coffee. Hashtag not sponsored, though I wish I was. Thoughts on AMD? Well, the move that happened this morning was the best opportunity to take profit. Um, but honestly, it wasn't nearly as spectacular as I had expected. Um, the market decision that came in the morning, where it gapped up, shot way back down, and then kind of tried to recapture, it was just a big disappointment, really. So I got out of my AMD position and took a small loss because, like an idiot, I like an idiot, I took a market order on my decision. So I don't know why I did that, but anyway, like it was basically break even. I wasn't hardly going to get anything for it, so I decided to just get out of it because it's expiring this Friday. Um, so sadly, AMD was a bit of a disappointment. I was expecting their earnings to be a little bit better. They what I was really paying attention to was the guidance, with the hope that their revenue and their earnings would still surprise, but neither one of those cases turned out to be true. Thank you for the $5, Boomer Assassin. I really appreciate that, dude. You don't have to do that. Um, so right now, the semiconductors sector, while I was expecting them to perform a little bit better, especially with them leaning on guidance to kind of push the valuation of their stocks higher than it did, we ended up with largely a huge disappointment, like a big nothing burger from AMD, from ON Semiconductor, and from NXP. NXPI is another semiconductor. They make a lot of stuff for like vehicles and stuff. They did have a pretty good move, and they held up over the last couple of days. This is the one that really did perform, but Intel and AMD, they had a slight bump up and then kind of just did nothing after that. And that was just because their guidance was a little bit better. I was actually anticipating that AMD would be the winner and not Intel, just based on history. But Intel lowered their expectations early on, which led to this down move in August through September. Which, you know, also prevailing market conditions also pushed them down. But in any case, they were ahead of the game and kind of they gave expectation adjustments early on, whereas AMD gave their expectation reduction much closer to the earnings report. So when earnings turned out to be bad, it seems like the market wasn't impressed with their guidance at all. So at this point, the technicals on AMD have completed that bear flag. I really was expecting. I really was expecting a bounce. Oh, this is AMC. What am I doing? It's not quite okay. So it's not quite completed that bear flag. We still have it being printed on here, but it hasn't completed the move. But this is what I was watching for. So we have this giant bear flag off of this move to the downside. And so far, it's moving up in this channel. But if it breaks down at any point below $60 again and closes a day below that, then that would indicate to me that AMD is going to continue to sell off, probably quite slowly. But all the same, AMD does not seem like it's going to do much performing. John Friedman says he is short on ON Semiconductors. Honestly, their technicals don't look bad. They keep bouncing off of their 200 period EMA on the daily, and the volume is still good. Like the moves that are stronger The bullish moves are the ones that are stronger than the bearish ones. And even despite the lowering price action, the volume indicates that there's a floor, that every time the price drops, there are buyers ready to step in. But that doesn't mean that there won't be another drop yet again. So it could drop to these liquidity levels down here at around $53, $54. Oh, thanks, Confidential. Bob Aitman says DBGI is doing a reverse split 1-for-100 Friday. After the reverse split, float will be only 500,000 shares. Could this be a squeeze? If they are doing that much of a reverse split, that's a lot. That's a huge reverse split. No, I'm guessing no. Digital Brand Group. Is this a clothing? Yeah, this is a clothing chain. I haven't even heard of these. I haven't even heard of these brands. They target the they claim to target middle and middle upper class, but I just think that they're probably in the wrong market right now. Their stock's been absolutely obliterated ever since April. There's really no life here. I would honestly stay out of it, homie. That's just my opinion. For there to be a short squeeze of any kind, you need to have like heavy short interest and positive price action that is pushing the stock against shorts and putting their backs against the wall. You don't have that here. The shorts are beating this thing down and taking profits every day. Maybe it's been like stalled out for a while, but like it's still in a clear downtrend. They have no reason to get out, and a reverse split indicates further weakness in the stock, so that doesn't really bode well for them. The fact that there's volume coming into this could just mean that shorts are piling in even more. So if things change at some point and shorts like get backed up against the wall, they've maxed out their utilization and the price action starts trending up and there's a clear reversal trend and the shorts are not getting out, then there's an opportunity for a short squeeze. But until the trend reverses, there really isn't. So you're trying to catch a falling knife. I saw Twilight Zone request MMAT. And after this, I'll go take a look at the SPY again. All right, MMAT actually making some really nice moves here. It's currently forming a double top though, so you might want to take profit here. You got a lower high on the price action with a clear double top pattern. So this is going to need to come back down and retest previous support at the very least. This thing's been on quite a tear for a while. The volume is decent. Their net income over the last 2 quarters has improved, but they are still operating at a net loss. Their float is still very huge. It's massive. Their market cap is decent. But given that semiconductors are not performing right now, these guys might end up getting pummeled on their earnings. And I wouldn't anticipate a change of trend with their earnings because they've reported bad earnings for the last 4 quarters. There really hasn't been any big changes between then and now. So while this move is really nice, I don't have faith that it will continue. just based on prevailing market conditions. Sorry if that's a bit disappointing, but that's just my opinion here. It's got a really nice reversal trend going. The moves are nice and strong though, so it doesn't mean that this can't continue, but it is going to need to find new strength after earnings. And in the near term, at least for the next couple of days, the price will probably start to come down a little bit. It's kind of like, it's just one of those things. The price gets too hot, it moves too quickly. It has to come back down, and usually it comes back down very slowly. And that often tricks people into holding on longer than they should. Hey, General Disarray, thanks for the $2, dude. I'll go ahead and take a look at FedEx. So FedEx was one that we were playing for a big gap fill. This gap is for 20%. Oh, we got to stop. Jay Powell is speaking. I got to switch to that. I got carried away. We're going to switch to the Jay Powell speech.
Since the beginning of the year. Inflation remains well above our longer-run goal of 2%. PCE prices rose, supporting the volatile food and energy categories. Core PCE price 0.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Have come in higher than expected. Price pressures remain evident across a broad range of goods and services for energy and food, and has created additional pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The bout of high inflation continues, the greater the chance that the Fed's monetary policy guided by our maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, like food, housing, and transportation, as it erodes able to meet the higher costs of essentials
really
like
choppy.
food,
I apologize.
housing, and transport. Raise the target range for the federal funds rate by 75 basis points. The process of significantly reducing the size of our balance sheet, which raise the target range for the federal funds rate by 75 basis points. The process of significantly reducing the size of our balance sheet, which basis points. The process of significantly reducing the size of our balance sheet, which with today's action, we've raised interest rates by 3 3/4 percentage points. Anticipate that ongoing target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation 2% over time. Have tightened significantly in response to our policy actions, and we are seeing the effect of demand in most of the economy, such as housing. It will take time. Most of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. Why we say in our increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last 2 press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And since our last meeting, the quality of incoming data and their implications for the outlook for economic activity and inflation, we will continue to make our meeting by being as clearly as possible. Quality of incoming data and their implications for the outlook for economic activity and inflation, we will continue to make our meeting by being as clearly as possible. demand so that it demand so that it demand so that it keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained of below-trend growth. Reducing inflation is likely to require a sustained of below-trend growth, maximum employment. Restoring price stability is essential to set the stage for achieving maximum employment in the longer run. The historical record cautions strongly at early. Understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. The Fed. Everything we do is in service to our public mission. The Fed. Everything we do is in service to our public mission. The Fed with stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between and let's say the December contingent on a string of better inflation data specifically between and let's say the December data, given the lagged effects that you mentioned?
Oh, okay. The stream is so choppy, and I apologize. I've looked at everything. There's nothing else wrong with my system right now or the setup, but it keeps cutting and going back. So this is happening for everybody, and I don't know why.
Or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to our 2% on the real economy and on inflation. On the real economy and on inflation. It's, for example, all across the yield. It's, for example, all across the yield. It's, for example, all across the yield. Financial condition. Financial condition. Financial condition. Financial condition. So, what I want to do.
Increase.
So, what I want to do.
Increase.
So, what I want to do is put that question of pace in the broader. So
I it's like listening to a broken record. So I apologize to everybody who's watching and listening, but this is the Fed stream that is this broken up.
Eventually, how long to remain it? On the first question. Expeditiously, we have clearly done so. We've moved expeditiously. We have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historic, given the persistence and strength in inflation and the low we started. That we'd raise that rate, we'd raise our policy rate, and we're that we'd raise that rate, and we put that in. To elective to bring into our 2%, and we put that in because that really does become the important question to our because that really does become the important question. But before we meet that test, and as I mentioned,
okay, he just acknowledged that rates are going to have to be elevated test, and that's much more than expected.
Data between the meetings, both the strong labor market report, but particularly that we may ultimately move to higher levels. We're going to find certainty. So we note that in determining the pace of monetary policy, with which monetary policy affect, I would say come closer to that level, move more. I would say come closer to that level, move more.
I swear the Fed operates on dial-up.
Become appropriate to slow the pace of increases. Come as soon as the next meeting or the one after that. Notice come as soon as the next meeting or the one after that. To be clear, let me say again, the question of moderate the pace of increases is much less important than rates and how much less important than rates and how.
I'm gonna try going over to the YouTube stream to see if it's any better, and I'll just go directly to it.
Fed policy is sort of driving ahead, and everybody else, dealing with their own stress as a result.
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamaros of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high fours, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Gina. Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that, so that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes
He's
entrenched.
deflecting.
And so
He doesn't want to answer this question.
The thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to the lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to
okay,
think about
this is hawkish. This is what we were waiting for. This is the
Our
language
policy,
that we were
we
waiting
need
for.
ongoing
He has
rate hikes
clearly
to
said
get to,
there is
to
no
that level of
way we
sufficiently,
can pause. It's too
restrictive. And
early.
we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections, which updates that. But I would expect us to continue to update it based
That's
on what
it.
we're seeing.
That's what we wanted to hear. And the market is hating it. And the market's hating
Powell,
it.
Neil Irwin with Axios.
That's exactly
as you
what
look
we
around
wanted
the
to
economy,
see.
The clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in
Puts
particular,
win.
are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
That was excellent.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not. It's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
He's being extremely hawkish here. I think that the market is going to continue this move to the downside and is going to accept it. We'll chop today, but ultimately the trend is going to be powerful to the downside after this.
That stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell. Janelle Marte with Bloomberg. So the Fed
is facing two more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of us, one of the policymakers, violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. And we've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make was covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted, and also you have to look at why why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode. We can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think.
Okay, guys,
as
I'm
we're
going to
farther
interrupt him
along,
here
we're
just
now
really
focused
quickly to mention that there is currently a falling three pattern. This is a technical pattern that indicates that the market is going to make a decision to the downside. What it very closely resembles a bear flag. You have one big red engulfing candle to the downside, and you have a 3 or more reversal candles, which make spinning tops with very tall wicks, but it's a weak move, and it's not reflecting in the MACD just yet. So what you expect is for this to retest and fail here at this level of this candle. So right now the market is about to make a decision to move to the downside. I think we're going to see continuation once it breaks down here.
Private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as people as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message.
Bullshit.
What I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So those I control those messages, and that's my job.
Edward Lawrence with.
What he literally just said is that it's
Fed
his
Chairman.
job
So
to manipulate the
how big of a
market to do
headwind
what
is all the
is
fiscal
required
spending to what the Federal Reserve is trying to
to
do
push
get
the
inflation back
economy
to
the way
2%
that is
target?
desired.
You know, in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path has narrowed over the course of the last year, really.
More
hard to say. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the Beveridge curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Okay, guys, that's it for the Fed meeting. I will probably go back here to the beginning a little bit later after we do a little bit more market analysis. Reason for that is that um, I want to take the time to actually listen to what he said in the beginning, even though that's already kind of, that ship has sailed. But this was a extremely hawkish stance, and that correspondent that jumped in there saying like, "Hey, the market's responding positively," like I feel like that was a prompt from him to say like, "Hey, get more aggressive," because there are institutions that have a vested interest here, and specifically that person spoke on behalf of Bloomberg. I was noting the correspondence, and Tim Rouse.
You still here?
I Hey guys, yes, I am still here in the Discord. All my audio is going over to YouTube right now. But anyway, as I was saying, the Tim Rouse, the original Nick Tim Rouse, the original correspondent that started the Wall Street Journal article, that kind of sent us on this this price run that we had since about like around October 22nd. His article is what pushed the narrative of this rumored Fed pivot that really wasn't, like, it made no sense. But it was enough to actually drive this market on such a strong move that led to this double top formation. And I really do feel like this was a setup to push the market in a direction that would benefit the institutions, to give them exit liquidity. And when I mean exit liquidity, I mean people who are bullish and getting trapped and getting their orders filled to buy things which the institutions desire to sell. The whole narrative of this, perceived Fed pause was banking on this speech, the statements that Fed Chair Powell was going to make here at this meeting. Everybody who was bullish was depending on him hinting at the possibility of a pause. And he didn't. He flatly said, no, it is too early for a pause. He said it very clearly. So this Fed decision, make no mistake, the market is not moving in as rapid fashion as it will for the duration of this week. We've still got earnings from a lot of big cap companies, but make no mistake, this whole move is a giant rug pull on all the bulls that were betting on this rally continuing. We had a double top rejection at significant areas of resistance here. Now, this area of resistance, we tapped on this as support at 390 1, 2, 3 times before we broke through, and we tapped it 1, 2 times, and now we just attempted to recapture it on this latest on the Fed FOMC minute note release. Algorithms pushed the price very rapidly up to 388, but never broke 390, and certainly didn't hold it. That tells us everything that we need to know, that the institutional decision was to exit, and they pulled in a whole bunch of bulls to swap their positions. And now the decision is being made to flip the script on all the investors that got trapped in long positions. And this is what I was warning everybody about when this rumor started circulating almost immediately. As soon as I heard this rumor, I was like, this makes no sense. The Fed has very flatly told us there is no room for error. There's no room for mistakes. They would rather over tighten than under tighten and deal with entrenched inflation. And notice how Fed Powell didn't want to hurt his own credibility by making any statements that would imply that he didn't have inflation under control, but he did very hurriedly rush to make statements that the pause wasn't coming. When that opportunity presented itself in the Q&A, he immediately took that unprompted and said, there's no pause. Like, to pause right now would be detrimental. And he also refused to admit recession because that would also hurt his credibility, but nevertheless spoke of tightening financial conditions. Make no mistake, we are in a recession right now. The job market is very much askew. I don't trust their data sources, for one, because their data sources are reliant on job openings rather than It's relying on job openings for one, but they're also double counting. They're using head counts for jobs occupied, and that includes part-time jobs. And how many people do you know in your life that are holding one, two, or at least two, maybe three, or even four part-time jobs in order to make ends meet? So full-time employment, whether somebody is full-time employed or whether somebody has three jobs to accommodate their financial needs, is not taken into account. It's just the jobs filled that they are counting. So if you have one person occupying three jobs, that's three employed people to the Fed or to the labor bureau, to the Labor Statistics Bureau. So that fallacy, that error in that margin of error, creates massive skew, because right now labor conditions force people, labor and financial conditions with huge inflation, are forcing people to take multiple employment. And it's not like we have a choice. So for people who are asking what's the play, like, the market's going down. That's the play. Market go down. I'm short. I was already short. This whole thing is coming down.
Hey, so something else worth mentioning too. One of the things that he hinted towards during the speech was that future target rates would need to move up. Something to consider is, come December, when we have the next FOMC meeting come December, the last time we saw a massive drop down off of FOMC information was because they revised their projections up. So if they're talking about 2023 going up, that's going to push up, obviously, 2024 and 2025. That's going to be on that projection sheet too. If they revise those to the upside, that's an even further kick down in December. And we have CPI next week. The CPI comes out next week, and if that's hot, if CPI is hot next week, that gives them a leg to stand on for a 75 basis point hike in December, and not the 50 that everybody's kind of projecting in right now.
Mm-hmm.
If they do that in December and change their projections for 2023, shit will get weird.
Yeah, no joke. This is in contradiction to something that I've been talking about for a while, about, like, the people call it the Santa rally or the Christmas rally or the year-end rally, holiday rally, whatever. This is seasonality is a powerful thing, but what the Fed is doing is going to kick the holiday rally right in the teeth with steel-toed boots. There will be no rally if they decide that they need to continue tightening and raising the target Fed rate in order to curb inflation. And right now, inflation's not calming down. And this is not only caused by the domestic policy, it's also being fueled by, external factors globally. We've got massive energy inflation happening in Europe, which is rising the prices of production in Europe, because anything that consumes oil, energy, gas, whatever, all of that is getting more expensive. That's making things more expensive for us. It's causing foreign powers to rush to the dollar, putting all their money in U.S. reserves, that U.S. cash. That's rising the dollar index and further pushing inflation. It's strengthening our dollar globally. And the decline of other currencies against our dollar continue to push inflation outside of our control. And the Fed can only do so much. The federal funds rate is very good at controlling the exchange of money flow between banks and the bank's ability to lend cash at desirable interest rates. But that's about all it does. That's the only control they have over the economy. And it can have very sweeping implications for the market. But this adage that you do not fight the Fed, don't fight the Fed, it's very true here. Seasonality will mean nothing if the Fed raises their target rate or allows the target rate range to go up in December. So now the December meeting is going to be even more important than this one, because what Jerome Powell just said, what Logical Chaos was pointing out, is that he was alluding to the possibility to increase target projections for the federal funds rate going into 2023. And he said that that decision will be made at the next meeting. That means if they decide that a 4% target is not sufficient, then they are going to raise to a 5 or even a 6% federal funds rate target. Not only is that going to be detrimental for the stock market, that's going to be devastating to the federal budget. Because what a lot of people don't understand about the ties to our federal budget and the Federal Reserve is that their target federal funds rate directly affects the deficit and the cost of servicing our debt. What does that mean? What I mean is that when the Fed raises the interest rate, it raises the interest on our national debt. So the rate of interest is directly tied to the federal funds rate. So the more expensive it gets to service this debt, the less cash our economy has to service our debt, and the smaller our budget gets. That puts immense pressure on Congress to really think very carefully about what of where money goes when making federal decisions and legislative decisions. We become a zombie country. That's actually a really good analogy for this. Our country is in a state where we have been so dependent on debt in order to continue to operate and to continue producing. We're so addicted to debt that we require this debt in order to produce anything and to continue operating. And as long as that continues, eventually we hit a breaking point where we can no longer actually service the debt that we've accumulated. And I feel like I've been thinking about this even long before I started playing the stock market, that we were rapidly heading towards this point. Hey, John Friedman, congrats on the SQQQs call. The short Qs for anybody else who is paying attention. This is an inverse ETF on the market. It tracks the Qs and inverses it. So whatever Qs does, SQs does the opposite. It's probably a bit late to get in. But yeah, SQs went from the start of the Fed speech, SQs was at $51.95 at the low, and it's now up at $57.90. So that's about a, what is that? That's like a well, I'll tell you what, I can actually just look over here to my right. Here it is, SQs. SQs has moved up 8% today. So shout out to John Friedman. Good play, dude. Anyway, what I was saying is that the addiction that our country has to our debt and our requirement in order to the requirement of debt in order to continue operating as a nation is what is slowly killing us. It's bleeding us dry. It's the same principle as like going to like check for cash, you know? Check for cash is an extremely predatory business practice, and I really sympathize with people that are in that position. And I'm not knocking anybody who is in that position where financially they have to go to check for cash in order to like handle a emergency, and you're operating with, you know, lower income. You're living paycheck to paycheck, and this isn't a I don't mean to like talk badly about people that are in that situation. If you are, I'm sorry. But it is extremely punishing to live like that, where you have to go to more and more shady debt servicers in order to continue living, in order to sustain your day to day. And that's what our country is slowly devolving towards. Even though we have a lot of sway in the global economy, because we still are, our dollar is still the federal, or it's the global reserve currency that gives us a lot of power, economically speaking. but it also puts us in a really precarious position as our credit worthiness declines from our debt continuously accumulating and our lack of ability to service it. This is going to force other global economies to make some very tough decisions about whether or not they will continue to prop up the dollar and continue to operate in good faith that the dollar has any value. And this is only going to further serve to make it more difficult for us to service our debt in order to get additional debt and take out new loans against our nation. It's all it's all rapidly spiraling out of control. Yeah, to AO's point, the stronger dollar is not good for exports, and this is also touching on the inflation topic we've been discussing for a while now. But yeah, the inflation problem is further compounded by the strengthening dollar. As the dollar moves up, the price of exports and the cost of exporting goods, or the cost of the U.S. importing goods, or for the cost of other countries exporting goods to the U.S., kind of one and the same. But regardless, this increases expenses for everybody, which raises the cost of goods, which immediately translates to inflation when we go buy things from the grocery store. So this is exactly the problem that we are dealing with. Shapuku points out that BTC moved up with the FOMC. I actually didn't take any notice of that. I haven't been watching Bitcoin as closely, but let's take a look at that because now I want to know. All right, well, Bitcoin's moving back down now, so I don't find that all that surprising. I thought that would mean that Bitcoin was still moving up, which would have made no sense to me. But Bitcoin is it's inextricably tied to the market right now. Whatever the market is doing, Bitcoin is also likely going to do. Okay. So moving on to the market technicals, we have made a touch to the top of our ascending wedge, and we're already about near the bottom, and we're slowly descending. But if you notice, the PPO indicator on the 5-minute is getting further apart, and the price cloud is widening out. So this means that we are moving very strongly. This bullish divergence, I would totally ignore. I'm not paying attention to the bullish divergence on the RSI right now because the move is too strong and it's too consistent. We're basically moving linearly down from this peak. This pump was totally fake. Right now, if you got into some SPXU calls when we had started this, and I was pointing out that this pump was this was just a fake pump. This is institutions trying to stop out traders, trying to punish anybody that's going bullish, stop out anyone they can so that they can get their liquidity to fill their orders to go short, either to sell assets they hold or to go short on assets that they want to go short on. We're slowing our descent a little bit, so we're going to start to enter into a chop phase at some point. I anticipate that we're going to test the bottom of this ascending wedge, which I drew this on the 1-hour chart. So if you follow this ascending wedge from this point here, where the market had kind of chopped around, and we draw this along the peak here and up to the peaks here as well, and then you draw another line along the bottom starting at the lowest low that we had and up along the lows that we had before. According to how it's drawn here, we've already broken through, actually. Let me go ahead and remove some more of these indicators so that we can more clearly see this. So this is my harmonic that I drew, and this also lines up to be a very bearish cipher pattern, which I was calling out about an hour before. But this ascending wedge is what I was waiting for. We've broken down below this. We've closed below this very cleanly. So this was it. We had a big surge after we had the CPI report drop. It gapped down after market open. Then CPI, then for whatever reason, the market just rallied out of nowhere, and we've been pushing ever since. And we've had these higher lows consistently here. And at this point, I think it's safe to say that we've broken this ascending wedge. This ascending wedge is totally broken. At the very least, we have broken through for the first time and are due for a retest and then the real move that follows, or I have misdrawn it and it's actually already broken through to yesterday, retested to enter again today, just before or just after the FOMC minute notes came out, and then rejected during the Powell speech. So if this current ascending wedge that I've drawn here is the accurate one, then we have already broken through, retested, and accepted the move to the downside. This indicates continuation to the downside. And we can go for a measured move, but ultimately I think that this will actually be much, much worse than that. And we're probably going to see the market move down at least the distance, back down to 358. So I'll go ahead and set a price target of I'll set a price target of 360 because that's a much more modest target. If you look at SPXU, let me see if I can put that back on here. If I go put SPXU on here, for SPXU, that price target is going to be around $20.50. So that'll amount to about I think that's like a 10.5. It's about a 10 to 12% move to the downside from the peak. We were trading at $17 flat when we had that peak in FOMC. And I do have the SPXU scale inverted, so take note that the numbers are going up as the chart moves down. That's because SPXU is an inverse ETF, so it moves down, or it moves down when SPY goes up, it moves up when SPY goes down. If you guys need any additional details on it, I have a video on my channel that describes playing leveraged and inverse ETFs. And as a matter of fact, if you're in the Discord, I'm going to drop the link to that in the trading floor. Okay. So for people who aren't familiar with the features in the Discord, if you use the HTF YouTube find command, that's HTF_YT_find, and then just type whatever term you're looking for, it'll go and find a video on my channel that actually describes that exact thing. I've got lots of informational and instructional videos to help out with that. So if anyone is confused or looking for more details on something that I have described before, then you can use that command. Anyone should be able to use that command, whether you're a trader or a denizen, hellion, or demon. I've also posted it in the YouTube chat for anybody else who's curious watching on YouTube. Hey, hi Kari. So are you Peaceful Lizard, the creator of the Price Clouds Oscillator? I see you in the chat. I took note of your name when I saw you in the comments. Scrap is my Scrap Queen is one of my mods. She's one of my analysts. Excellent. Hi, Kari. I am so pleased to have you. Yeah, absolutely. I am True X Demon on TradingView. Yeah, that's super cool. So Hikari is who's in the YouTube chat right now is he's actually the developer of the Price Clouds oscillator. And I'll take the time to actually shout out another member of my Discord, Tempestuous Persephone. She's actually the person who found this indicator, the PCO or the Price Clouds oscillator, and I fell in love with it because the price clouds were so good at predicting reversals. Like my strategy for this is that every time there was a touch of outside the price cloud or a near miss of the price cloud, I would take note of it, and then on the next market low, um, if there was another dip after that where the price cloud either had a higher low, I would immediately go long, and you could play that to the upside, and you would have caught this move. So like this is the first touch in the outside of the price cloud, and then the next higher low on the price cloud with a lower low on the price chart. That immediately is a signal to go long on the market, and then set your price target for your last high. And yeah, I've been working with this strategy. It's been extremely effective, and yeah, it was so cool to actually be reached out to by this guy. Like that, this was a super awesome. This is the best MACD indicator that I have ever used. I love it so much. It's remarkably accurate, and it would be so cool to create a strategy through TradingView based on just this indicator. Like this is an excellent, excellent, excellent indicator for creating buy sell signals. Like almost on par with LuxAlgo. I've seen the usage with LuxAlgo. We've actually compared this as like the free version of LuxAlgo on the channel. It's really that good. So like huge kudos to you. Yeah, if yeah, just as a huge thank you for developing this. I would be so thrilled to have you in Hell's Trading Floor. We're actually a really really nice community of like the whole thing with Hell's Trading Floor is like a huge joke, really. But I just went and ran with it. A brand is a brand. But anyway, we're all about teaching people how to trade and giving people like real trading advice that will allow them, good guidance really, so that people can learn how to trade. So it's and we don't really have too many people that are building tools. We've got a few members like Chan Dagger. Shout out to you, dude. He's been building another strategy separately for the Discord. We got Mr. Flabbergank, who's one of the principal developers of our team. He actually built a proprietary bot with us. We're all super, super thrilled about creating tools that help retail investors build their capabilities and make the most or give themselves the best advantage to be right on their trading decisions. So anyway, yeah, again, thank you, Hikari, aka the Peaceful Lizard, for making the Price Clouds oscillator. I'd love to see some other stuff of yours. I've actually been meaning to go and look through your development list to see if you've made any other indicators. Anyway, so moving back to the 5-minute on the SPY, pretty much as I pointed out, we were getting really close to a sideways chop zone. So if you're in a day trade right now, if you're day trading puts on the SPY, this is a good take profit zone right here. We're right at a zone on a zone on the SPY where we're hitting some pretty significant support. We've actually bounced off of this area a few times, and I do expect us to eat through this. So if your if your puts expire today, I would take profit on that now. And just go ahead and do that. If you want to play continuation to the downside going for the rest of the week, I honestly would be going short until November 18th. Like I'm straight up like staring down puts on SPY and SPXU calls until November 18th, because this FOMC meeting confirmed everything that I've been saying for the last 2 weeks, that this rally doesn't really make any sense, and we need to be really careful and be on the lookout for a top. Play the rally and take money where you can get it, but be ready to switch short. Look for very clear divergence, and we got it. And as it so happens, we had that exact divergence once again. I'm going to go ahead and get rid of SPXU because we don't really need that anymore right now. We had 1, 2, 3 higher highs right here at the top of this ascending wedge. And the whole time we had this, we had the MACD moving down with one touch outside of the price cloud. So my strategy with this, using this indicator, has been to look for the first touch outside of the price cloud, and then just wait it out. Use that as a take profit on long positions. That's your indication to just get out of your long positions and wait for an entry to go short. And usually that entry is followed by, that entry is indicated by bearish divergence on the RSI, which we got here. So this is my alert signal to exit long position. The RSI bearish divergence with higher high on the price, lower high on the RSI is my signal to switch short. And I use this dead to rights accurate that as soon as we were closing the day with this bearish divergence on the 1 hour chart, this was perfect signal. And we did get that big gap up the next morning, or the 2 mornings after, excuse me, but we still ended up being right. So even if we were a day early, it's not about being perfect. It's about being close enough. You don't have to do it perfect. You just have to be close enough. And this is why I swing trade, not day trade. Because for me, if I day traded this and I went short, yeah, I could have swung it overnight and taken profit first thing in the morning. That could have worked out. But I might have decided to get back into the position, and then I would have gotten stopped out on the gap up the morning after. So, not that I'm knocking day traders, but there's some inherent risk and a little bit of extra blood pressure. There's elevated blood pressure that goes in with that. So, yeah, that is essentially my analysis of how I've traded this entire market since finding this particular tool. It's been immensely useful, just so awesome, so super awesome to have. And look at that. As a matter of fact, we had another signal here at the top. Remember, we were talking about a diamond top pattern in the SPY as well back in early October. This was another example. If anybody was curious about another example in order to look for exit long, switch short, this was it. You had the touch outside the price cloud that happened right here when the market was chopping up here. So you exit right away, and guess what? You would have, even if you had captured this price movement, it's negligible, less than 2%. Forget about it. An exit right here would have been perfect. As soon as it touches outside of the price cloud and you see it weakening right here, or you get a bearish divergence, that's your exit opportunity. That says get out of your long position and go short. You can go short here, but sometimes this is early. It's a little bit too early to go short. And then, as you can see, we made a higher high, but that ended up being bearish divergence on the RSI. So as soon as you get that bearish divergence signal from the TMA divergence indicator, immediately go short, ride the market down for the next 2 to 3 weeks, and take profit once you get a new low on the MACD. It doesn't necessarily have to touch outside of the price cloud for you to switch short, but you should definitely have a price target in mind. You could have had a price target here at the bottom at the last low, or you just play volatility and wait for, say, this. I should have exited my short positions here, but I didn't get up that morning So that's what happened to me on the CPI day. So anyway, we've already gotten all the signals we need to know the market is coming down. So we are net short basically everything. We don't have to think about it, worry about it. We're short for the next 2 weeks on the SPY. I think the tech sector is probably going to have a hard time of things. We might see some pushback from the defensives. Think energy, consumer staples. Let me pull up the stock market heat map so I can think about this a little bit. Yeah, see, tech is getting murdered right now. Tech is getting annihilated, and even energy, minerals, producer manufacturing, and health technology, even these sectors are blood red. So this is a bad day for everybody right now. The defensive sectors like health services and utilities they're holding up a little bit better, but they're still, for the most part, it's pretty rough out there. So let's also take a look at the performance on the weekly. And this will give you a better picture of where the defensive sectors have been. Banks are doing well with their earnings. A lot of these banks just reported their earnings, so they did really well, which they tend to do during high interest rate environments. You've also got insurance companies in here like Progressive, PGR. That's another example of a sector that does well. Aflac Insurance, they also did very well. A lot of those insurance companies perform well during these financial conditions. Contrast this with the consumer durables, the tech sector, transportation sector. None of these are doing well, which actually brings me to another signal that I just learned about this yesterday. There's a specific type of signal called Dow theory, and you can use this by looking at the Dow Jones Industrial Average Index, and then add to your chart the Dow Jones Transportation. So this is the DJT, Dow Jones Transportation Average. This is specifically targeting the Dow Jones transportation sector stocks, which, if they diverge from the Dow Jones Industrial Average, then there's something wrong. So I'm going to go ahead and switch this over to candlesticks so that we can see this on a one-to-one basis. I'm going to do, okay. So we're going to have the Dow up here, and we're going to have the Dow Transportation Index down here, okay? So we got the Dow Jones up here, and we got the Dow Jones Transportation down here, okay? Now, you can see generally they're following the same trend, right? But what's different, what changes here, is that you have this weakness up here at the top. There was a double top formation here on the transportation index, whereas you had a higher high on the Dow Jones. So that is our first warning sign, our first red flag that something is wrong. The final one that really told us something was off is we had this higher high on the Dow Jones, but we had a lower high on the transportation sector. I'll zoom in on this so you can see it really clearly. See the wicks here on the Dow Jones Transportation? We had a lower high right here from Monday, October 31st to Tuesday, November the 1st. But on the Dow Jones, we had the opposite. We made a higher high on the Dow Jones Industrial Average. So these two divergences right here, these little subtleties that kind of messed things up, this is a signal that the market move that's happening in the industrial sector is not genuine. Because the theory goes that the transportation sector, which is what all logistics hinge upon, all sectors that have a producible good rely on transportation sector in some way or another in order to push product to shelves and get sales out. Everything requires logistics and transportation. So if the transportation sector is doing poorly while the rest of the market is going phenomenally well, then that should be a red flag showing that something is wrong and that the market is nearing a top. And this is actually one of those rare signals that has been extremely accurate in the market for a long time. And as a matter of fact, the Dow Jones theory called the market top. So there was a lower high on the Dow Jones Transport Index, while the Dow Jones made a higher high in August. And if you had just played this signal, then you would have gone short on the entire Dow Jones at exactly the top. You would have exactly topped the market. And the whole move to the downside, you could have captured the whole way down. The transportation sector did even worse than the broader Dow Jones, but this divergence would have been enough to signal, hey, the Dow is acting funny. So a little bit of stock market theory for you guys before I have to head out. Sadly, I do have to go for a meeting. It was already pre-scheduled, but I want to thank you guys for joining. Scrap Queen, you can go ahead and add Hikari to the Discord. If one of the other mods are available to go ahead and grant him access. Hikari, when you jump into the Discord, just come into discord.gg/Hell's Trading Floor. Go ahead and jump in. I already saw your private message. Yeah, I see the message. So identity confirmed. This is good enough for me. So I'm really thrilled to welcome you to the trading floor. I'm so thrilled to have somebody that wants to join the quant team. It feels like we're really building a genuine quant team. You've actually got some fans here in the Discord for that indicator. So we're super thrilled to have you. All right, I'll answer the last few questions, and then I have to go promptly at the market close. So Bankster asks, how will FOMC macro for the next 2 weeks affect selling meme CCs with earnings on AMC next week, in your opinion? Well, so overall, I would trust the IWM to tell us the answer to this question. The IWM, or the Russell 2000 ETF, is one of the largest mid-cap ticker ETFs, and what I like to do with this is I like to actually do a ratio chart of IWM versus the SPY to determine who's going to outperform. When this is going down, then SPY is outperforming the IWM. When this is going up, then IWM is outperforming the SPY. Generally, though, I would say that both are going to get dragged down, and we're going to see a little bit of negativity across both of these ETFs, which is going to mean negativity for stocks like AMC, Mullen, Senseonics, Biora, any stock that's trading mid-cap on the Russell 2000 or even the Russell 1000 and 3000, all of these are probably going to have similar difficulties. All right, that is my time. I have to go. Thank you guys again so much for watching. I look forward to seeing you next time. But until then, have a hell of a time in the markets.
Take it easy, TD. Thanks.
Peace out, guys.